Okay, let's talk about business analysis using balance sheets. So there's three things in balance sheets that we have to count on or think about. And the first one is cash being king. So the first thing we're going to talk about is cash is really important. So we say cash is king. And in fact, you will hear me say quite often that cash is king because it is. For example, if you are trying to make payroll, can you hand an employee an iPad? Well, maybe once. But the next week they want a paycheck. And so when you start thinking about whether you're going to make payroll or not, cash becomes very important. So when you're a business, the most important thing you want to watch is your cash flow. If you don't have cash to make payroll, you're going to have a big problem. The second thing is debt equals leverage. And the reason I say debt is leverage is an example that I use of housing. So for example, if you paid cash for a house, say a $500,000 house, and it went up 10% in value, well, then you would make $50,000. Most of you can do that math in your head. But if you paid $100,000 down and borrowed $400,000, you used debt, $400,000 worth of debt, and it went up $50,000, what would your return be on your original $100,000? You'd have a $50,000 return on your $100,000 investment, so you would make 50% on your money. In the other example, whether you paid cash for it, you would have only made 10% on your money. Therefore, debt is leverage. So when we think of our balance sheet, first thing we look for is cash. Can they pay their bills? Are they going to make payroll? The second thing we look for is debt. All right, how much debt do they have? How much leverage do they have? And leverage is another word for risk. How much risk do they have? Obviously, if the house can go up 10%, it can also go down 10%. So if we take that same example and we think about it in reverse, say the $500,000 house goes down 10%, now it's worth $450,000. Well, our original $100,000 investment got cut in half. So now we only have $50,000 left. So debt magnifies the result of the company. The more debt it has, if it has good results, the better results will be. If it has bad results, the worse the results will be. The third thing is value doesn't equal cost. When we talk about cost and value of things, we can look at the balance sheet and we'll see fixed assets. Well, fixed assets have been depreciated. So if you imagine a house, say a house here in the Bay Area, a house here in the Bay Area falls in disrepair every year to a certain extent. We get to write that off on our taxes, so we get to write off depreciation. So we, as a company, gets to write it off, not a homeowner. But when you think about this disrepair, that doesn't mean that the value of the house went down. So if you looked around the Bay Area, the housing market's been quite stellar, so the prices of the houses are going up, even if they've been falling in disrepair. In fact, some of them have fallen in so much disrepair, they're teardowns. So when you start thinking about value and cost, the balance sheet can be very misleading with regard to what value and what cost are being shown. What's being shown is a depreciated cost. From the original cost depreciated down over time all the way down to zero. So they may have assets that are on their balance sheet that are costing out at zero but have a huge value because they've been depreciated down to zero. So there's three things when we analyze a balance sheet we're looking for that are really, really important. The first one is, can they make payroll? What's their cash look like? Do they have working capital to continue working? The second thing is, how much debt do they have? How much risk do they have? And how much leverage are they using? And the third thing, of course, is, are the costs and the value that's being shown in the balance sheet relative to what they really are worth and what they could be sold in the marketplace, or are they more like depreciated book value? So think about those three things and when you're analyzing balance sheets.
Thank you.